Welcome to The Explainer. So, today we're diving into a topic that completely flips the script on how we look at corporate accounting. Look, if you've ever stared down a balance sheet and just seen a massive, intimidating wall of boring spreadsheets, you are definitely in the right place. We're going to change that perspective entirely today. Instead of just dry math, we're going to treat corporate financial statements like the ultimate diagnostic health report for a business. It's basically an X-ray that reveals exactly what's going on beneath the surface of any company.
Here's our roadmap to demystifying this whole thing. We're breaking it down into 5 digestible pieces: the corporate health report, facts, rules, and human judgments, why do we need them, decoding Schedule 3 rules, and finally, the accounting blind spots. Let's get into it.
Section 1. The Corporate Health Report. The ultimate communication tool.
Okay, let's start with the absolute basics. Financial statements are the formal annual reports that corporate management uses to communicate financial info. We're talking about the balance sheet, the profit and loss statement, and the cash flow statement. These are really the end products of the entire accounting process. Think of them as the primary bridge connecting a company's hidden inner workings to the outside world. It's literally how a business speaks to investors, tax authorities, the government, and even its own employees.
And here is where we get our first big narrative twist. Straight from the American Institute of Certified Public Accountants, we get a definition that honestly might surprise you. They state that these reports reflect a combination of recorded facts, accounting principles, and, here's the kicker, personal judgments. Right? That is a massive light bulb moment. These reports aren't just cold, hard, objective math. They are actually a deeply human construct.
Section 2. Facts, Rules, and Human Judgments. Deconstructing the numbers. So the crucial takeaway here is that every single financial statement is built on 4 distinct pillars. First, we have recorded facts, which are based on historical costs. Then come accounting conventions, like pricing your inventory at cost or market value, whichever happens to be lower. Third, we rely on postulates, things like the going concern assumption, which basically just assumes a business isn't going to vanish into thin air tomorrow. And finally, personal judgments, like estimating the useful life of a piece of machinery for depreciation. It's this wild mix of rigid history, agreed-upon rules, and totally subjective human estimates.
What's really fascinating here is the tension between these pillars. Take recorded facts, for instance. Assets are rigidly shown at their historical cost. That means if a company bought a plot of land 50 years ago, it might still show up on the books at that original, totally outdated price, completely ignoring its booming market value today. That is a rigid fact. But then, on the flip side, you have things like provisions for doubtful debts, basically guessing who won't pay their bills, or asset depreciation. These rely entirely on personal opinions. It's kind of crazy when you think about it. While some numbers are undeniable facts, others are literally just the corporate doctor's best guess, or, a very educated fortune-telling session.
Section 3. Why do we need them? The diagnostics.
Now, if this report is such a mishmash of historical artifacts and human estimates, you might be wondering, why is it so vital? Well, we use these diagnostics to track economic resources and then predict if the business is actually going to make money. From there, we analyze the cash flow, which is really the heartbeat of any company, judge how effectively management is using those resources, and finally, report on their social and environmental impact. At the end of the day, these statements give stakeholders the diagnostic power they need to make massive, real-world economic decisions.
Section 4. Decoding Schedule 3 Rules. The Rulebook.
Because these reports are so incredibly crucial, they obviously can't just be the Wild West. Schedule 3 enforces strict presentation rules to make sure every company's health report can be easily read and compared by anyone. For example, check out this mandatory rounding off rule. It actually shifts depending on the size of the company. If a company's turnover is less than 100 crore rupees, they can round off to the nearest hundreds, thousands, lakhs, or millions. But the second they cross that 100 crore threshold, boom! They are restricted to rounding only to the nearest lakhs or millions. It absolutely forces massive companies to cut the clutter and present a much cleaner, readable X-ray.
But arguably the most vital rule introduced by Schedule 3 all comes down to a single number: 12. This represents the ticking clock of the 12-month operating cycle. This 12-month clock is basically the foundation of the modern balance sheet. It acts as an absolute dividing line, neatly splitting the company's X-ray into 2 very strict categories: current and non-current. If an asset is expected to be realized or a liability settled within this 12-month ticking clock, things like cash on hand or trade inventory, it's classified as current. Conversely, non-current items are your long-term assets or obligations that extend way beyond those 12 months, like huge fixed assets or long-term debentures. It brings incredible clarity to a company's short-term survival versus its long-term strategy.
So we have this highly structured, rigidly regulated, smartly categorized corporate X-ray. Honestly, it looks flawless on paper. But we really have to ask a critical question here. Is it perfect? Does it actually tell the whole story?
Section 5. The accounting blind spots. Limitations of the X-ray. The short answer? No, absolutely not. Just like a medical X-ray can't tell you if a patient is in a good mood or feeling energized, a financial statement has some major blind spots. For one thing, as we discussed, the X-ray is inherently biased by those personal judgments. It's also entirely aggregate, meaning it shows total sales, but completely hides which specific product is dragging the company down. And worse still, it's trapped in the past. It records assets at those outdated historical costs while totally ignoring inflation and the changing purchasing power of money. Which leaves us with a pretty provocative final thought, and this is what I really want you to take away from this explainer today. The next time you're looking at a perfectly formatted, legally compliant balance sheet, don't just see indisputable math. Ask yourself, where do the hard historical facts end, and where do the human opinions and estimates begin? Understanding that invisible boundary is the true key to decoding corporate health. Thanks for joining me on this explainer, and remember to always keep questioning the numbers.